Ladies and gentlemen, welcome back to the Schaeffer's Market Mashup. Your host here, Patrick Martin, pleased to bring on another very esteemed guest, Steve Sears, President and COO of OptionsSolutions.com. Steve, thanks for coming on. It's great to finally meet you and get this going.
Great to be with you. Thanks for inviting me today.
If you're familiar at all with options trading and its history, you know Steve is a legend in the business. So today we're going to talk about options solutions, various strategies, dive into the psychology of investing. I've heard Steve's got some stories he can regale me with, and we're going to try to tie it all together with some current market events going on. But first, for new guests, I like to open it up with some background information, your career, your high points, your low points. You have a bio that could go on for days. So I'll hand it off to you and just tell everybody, how you got to where you are now and the story along the way.
Well, thanks again for having me. It's a real treat and honor because, Bernie Schaeffer is one of the first people who really taught me about the business. When I was a wee lad, I was a reporter at Dow Jones Newswires and the Wall Street Journal, and I had this deep fascination with what went on inside of the stock market. My goal when I first started was to understand what it meant when the newscaster said in the evening that the stock market rose or fell by whatever points. And one day the old man called me into the office and he says, "Sears, we know that you're interested in what actually happens deep in the market. We want you to cover options for us to start that beat." And I said, "What the hell are options?" And he says, "We don't know, but we think it's important. Go figure it out." and therein began this incredible fascination with this world of puts and calls. And I got very lucky at the time because so many of the people who are truly like world-class, great traders and investors, at the time had sort of been operating by themselves in the options market. Nobody really knew that they existed. And, I was lucky with the timing because I got to call these people up. And then they'd explain to me how volatility actually works and put calls and pricing and strategies and things like this. One thing that sort of led to another, and the fascination hasn't really ever subsided. I had a big story, a big miscarriage of capitalism story, wherein I once asked one of the exchange executives, "Why is it that blue chip options only trade at one exchange and they're not multiply listed?" And I didn't get a very good answer. In fact, I was told that it's not a story, which, of course, tell the journalist it's not a story. It is.
That's when you lean forward a little bit, yeah.
Right. So fast forward, we wrote about it, and then the very next day, the Department of Justice Antitrust Division launched an investigation, and the SEC. So I wound up changing the industry dramatically in terms of the listings, the regulatory structure, the competitive structure. I went to work with Sandy Frusher at the Philadelphia Stock Exchange, the oldest stock exchange in America, by 2 years. That was a turnaround. It was sold to the NASDAQ.
Yep.
And then Bill Porter, who founded E-Trade, wanted to automate electronic trading. And I got super lucky and got to be part of that at the International Securities Exchange, which went public on the New York and then got bought by NASDAQ. And then after all that was over, I went back to Dow Jones, this time as a columnist at Barron's, and started coverage of the options markets for Barron's.com. Also write the striking price column for the print magazine. And I continue to do that, although no longer on a full-time basis, because Bill Brodsky, the former chairman of the CBOE, his son Michael Brodsky, and I have started Options Solutions, which is an RIA that helps people use options to curate their portfolios. That, in a very long nutshell, is how I got here.
Yeah, I love the personal bias here, of course. As a liberal arts major, worked at the student newspaper, have my own pseudo quasi-journalist adjacent background. I love that that's how you got your start and that you were the first to shine a light on this industry that right now is booming. I mean, could you ever have thought when you first started looking at this that you would see the volume that you see right now?
No, it's funny. I remember back in the late 90s, if we traded 1 million contracts a day, it was a huge day.
Mm-hmm.
And I think we traded 38 million yesterday.
Yeah.
I never thought that I'd see anything this big, quite frankly. I always knew that it was important, and that no matter what happened in the stock market,
mm-hmm.
the options market was really the probability lab. And I was fascinated by that, and I think more people are realizing that.
Mm-hmm. Yeah, even I'd say in the last 5 years or half decade, it has blown up and it has become now mainstream. It's crazy. But I want to focus more on some of your website. I know you guys do a great job of outlining your your guiding principles. I pulled one quote from one of your articles. An investor must be willing to buy the stock at a lower price or to sell the stock at a higher price. In return, an investor can collect options premium. I love the way you break that down into a very simple, compact, concise way. But now with, we're on a pod, would you care to expand on that philosophy a little bit?
Yeah, absolutely. One of the things that I think is always difficult for most people is trying to understand what exactly happens in the options market. Like my father told me long ago when I was a little kid, you never give people more than 3 choices because they'll never be able to make a decision. Mm-hmm. Well, in the options market, we have many different decisions to make, but there are 4 fundamental objectives that all investors have, regardless of how they choose to enter the financial markets. Mm-hmm. Most people want to buy below the market, they want to sell above the market, they want to reduce risk, and they want to generate income. And what I found in my experience is that when you speak to people through those 4 key facts, mm-hmm. it helps them to make sense of the options market, which for a variety of reasons, none of them good, remains shrouded in complexities.
A lot of what you discuss, I wouldn't say necessarily it's a conservative strategy, but it is proactive in embracing certain principles. Those 4 pillars. What specific sectors and stocks does that apply to in this current investing climate?
Yeah, that's the great question. There's
mm-hmm.
no New Yorker cartoon we have in the office that shows this guy sidling up to a bar and speaking to a couple, and he says, "Sometimes I sell puts and sometimes I sell calls. It's a full life." And at this juncture in the market, it honestly depends on where you are situated. Mm-hmm. Rather than trying to prescribe or suggest one strategy, what you see is that there's almost a shifting or a segmenting in the demographics. So if you were to take, let's call like the millennial Reddit crowd, incredibly, this group is oftentimes buyers of call options. Why? Because they use call options to rent exposure to stocks, and they're playing these sort of moves. And then if you get up to an older demographic, people in retirement trying to generate income, you often see them selling call options to generate that income. We call that the income a conditional dividend. What's the condition of the dividend? Like you got to be willing to sell the stock higher, or if you do the put, the condition is you got to be willing to buy it lower. And then sort of what happens in between all of that? Well, all kinds of different things. Like people will use strategies to hedge events. They will use calls as proxies into events. They'll use long calls if they're concerned that the stock market is too high or their stock prices are run too far too fast. Why? Because an option controls the stock, but for a lot less money. Mm-hmm. But if I had to if you force me into a corner and say like what are the key strategies you see, I'm seeing tons of call buying in ways that defy everything that we were taught, which is that you almost always want to be a seller of options. You want to collect you want to collect the premium. The millennial generation, the Reddit traders, don't see that, and that's new. And then you're seeing put selling has been a massive strategy during this bull market over the past, really since I'd say 2009, 2010. Even prior to that, of course, but that's become a mainstay. And then the old simple overwrite. I'm long the stock, I'm short a call. That's become huge too. And I see those basically as the 3 of the main strategies constantly at play. Whereas before you might just see one-way, what we call one-way paper, or everyone doing the same thing. Now it's much more diverse for reasons of demographics and need.
But do you see that demographic shifting in any other particular direction in the next, 5 to 10 years? Or do you see millennials in the Reddit crowd becoming somehow maybe a little more savvy to some of these strategies like the selling of premium that you've talked about?
I think so. I think my prediction would be that going forward, you're going to see options will be increasingly used by people in retirement to generate income. Mm-hmm. And I think that's going to be a huge zeitgeist moment for the options market. If you look at people who are just starting out their financial journeys, I think you're going to see there that they too are going to evolve, because what happens is people start out small and they make mistakes, and when you're just at the outset of your career, you don't really have that much money. Most people don't have that much money to begin with. Mm-hmm. So they do things that might be outsized risk, but they're punch really, and they're learning what I call that Karate Kid, like wax on, wax off type stuff. And then as they get a little bit bigger of a nest egg, or their trading accounts increase in volume, then you tend to sort of see an interest in more sophisticated or even nuanced strategies. And if you were to ask me, I would think that in 10 years that this market is going to be bigger and it's going to be much more proactive and perhaps less reactive. I think people are getting more strategic.
I think that dips into a little bit of the psychology of investing that I want to talk about. Equity investing and options trading are require different mindsets. How do you differentiate between the two, and what does that say about the psychology of options trading?
I always like to say that an options investor is a thinking investor. And if you like stocks, if you like your stocks, you're going to love options, because options are the most in my experience and view, they are the most sensitive instruments for which to understand stock. And in fact, this is something that I learned many years ago from Bernie Schaeffer, amongst others. Like, why would you buy a stock or consider buying a stock without first looking to see what the options market is telling you? And so psychologically speaking, in the past, I'm going back, let's say that up into the mid to late 90s, the options market, as you know, is dominated by retail investors. They're often horrible traders, speculators, dentists, lawyers, people who are picked off by these cold-blooded floor traders.
Sorry to interrupt. I saw your Twitter. You had the comic, or I think it was the doctor says don't buy stocks in September.
People are now seeing I think that the key lesson from the global financial crisis is that volatility is a fact, and it happens to you, or you can do something about it. And many people decided to try to do something about it. And for all the 5 inputs that go into determining an options premium, implied volatility is the most important. Mm-hmm. And you're seeing people increasingly try to find ways to monetize that, to control it, to use it to reshape returns. Because everybody likes to say that they're a long-term investor, but if you look at the Dalbar research, it shows that people actually behave like very bad short-term traders. Mm-hmm. Nobody owns anything long enough to actually benefit from the natural cycles of the stock market. And the psychology of the options investor, I believe, is a little bit more analytical. It's a little bit more clinical. You might own stock XYZ that is suddenly not in favor, but you have it for a low basis. What are you going to do with it? Well, a lot of people are going to say, I'll just let it sit there and collect the dividends. That's fine. Mm-hmm. Others are going to say, well, I might be a seller of calls on it to take advantage of that range-bound nature. So the options investor psychology, to me, is much more proactive. It's much more analytical, and it's oftentimes steadier, because when things happen, the options investor tends not to just panic and push the button to bail. And in fact, what we know is that when we see a big increase in hedging, as we have in recent weeks in the index markets, it tends to be have a calming effect on the stocks. And if we look today, the markets are up at they continue to dance around record highs. And I think that is evidence that the options investor psychologically is a little bit hardier and more robust than is generally understood or appreciated.
Yeah, it's very well said. And circling back to what you said about implied volatility, I think options traders have that wrangled, and they have a stronger grasp on that. As a journalist, how does one go about proliferating implied volatility to a broader market so we can attract more, basically educate an audience that wants to learn about the options market?
I'll tell you, when I started out many years ago, I was struck by the fact that there was no central barometer of the options market. And that at the time there were 5 exchanges. I think today there's 17 or more. And it occurred to me that what was needed was a Dow Jones Industrial Average for the options market. And thus I seized upon the CBOE Volatility Index, or VIX. He named it the fear gauge. The CBOE hated it. And it's since morphed into a tradable index, not just a tracking index. But I think in terms of education, the thing that we can all do is actually just have some serious, honest dialogue about what it is and what it is not, and not over-intellectualize it. Like, in many ways, the VIX has become financial silly putty. People talk about it as if they're, with a passion one might feel for their children or their spouses. But really, all it is a barometer of, either fear or greed, and I'm simplifying it a little bit, but like, there's an old ditty that we have, like, when the VIX is low, it's time to go. When the VIX is high, it's time to buy. Now, when the VIX is markedly higher, and 19 is basically the long-term average, it tends to be an indication of massive fear in the market. And when it's low, it can be an indication of complacency, but it could also mean that options premiums, i.e. put and calls, are not trading with fear and greed premiums. And it was your Bernie Schaeffer who really introduced me to the contrarian mindset, which I think is so helpful when thinking about volatility, and then about options, and then about investing. And it was the great Humphrey Neal who said, and Bernie would quote this, that the public is right on the trend, but wrong on both ends. And so I think using VIX as sort of the divining rod or the volatility compass is a great first step that anybody can take. And if you study it and seek to understand just the fear gauge, the tracking, the non-trading index, that you're going to have quite an advantage over everybody else. You can have another piece of data, another piece of the puzzle that other people will not necessarily have, and that'll make you a better stock investor over time.
Wholeheartedly agree, and at least on our digital content side, we try to bring the VIX up every possible chance we can get in our daily newsletters. And this isn't even meant to promote it. It's just meant to show that, like, that's the added tool that I think anyone just scanning a little piece of, okay, VIX is, lowest close since July, or, 3 straight weekly losses. You just kind of slowly feed them that piecemeal, and they will start to grow comfortable with it. But I'm glad you brought up the fear gauge stuff. So that has been, if you Google our site and type in fear gauge, you'll get just countless ones, because that's how we refer to it. So when I found out that you were the one that penned that, I needed to hear a little bit more of that. So give me some context behind, I guess you're the father of the fear gauge, or the fun uncle. I don't know how to.
I call myself VIX's uncle. I think Bob Whaley's the father, the Vanderbilt and Duke professor. He actually came up with it. And necessity is truly the mother of invention. I just seized upon it. I needed a device to tell the story. And that was the one that I chose. And the crazy thing is, back when I started to do it, if the column in the paper ever began, the CBOE Volatility Index, rose while stock prices fell, it was almost an inside joke that there was nothing going on.
Yeah.
because it's behaving the way that it should. And it's been fascinating to me to sort of see how it's morphed into some sort of, there are people who technically analyze, VIX movements and things like that. I pay a lot of attention to it insofar as on my machine, which I'm looking at now, I'll track the Dow, S&P 500 futures, S&P 500 cash, SPY, NASDAQ futures, NASDAQ cash, skew, and then I get down to the VIX. And I use VIX still as a very broad barometer of premium. And the way that I think about premium, if the VIX is like a tree, the way I think about, the shade cast from that tree is there a fear or a greed premium in the puts and calls? We all know that VIX's long-term average is 19, and so if VIX is trading at 1555 as it is now, looking like it could go lower to 1410, to me, the message there is that stocks are expensive, at relative levels, but options volatility is not. And if you have that sort of analytical options mindset that I know so many people have, that informs your strategy. Now, people will get much, much more into the weeds on this than they should, because the VIX futures curve is dripping with information.
I've had SIBO guests on that we have unpacked the VIX curve and how you really have to, like you said, dive into the weeds to find an opportunity there. But
if you want to go down that deeper, more quantitative, wonkier route, it's there. But if you just look at your benchmark indexes, you look at the VIX, and you basically try to crack open VIX at an individual stock level. And by that I mean you look at your implied or realized volatilities, and you compare it to the VIX's level and the SPX. You get so much more information about the market or about your equity investments than anybody else, and I think that provides some edge. It used to be an extreme edge over other people, but as you pointed out earlier, the trading volumes have exploded, and what we're talking about becomes a poorly kept secret, but a secret nonetheless.
Yeah.
If you don't know it.
So we've danced around the topic about risk appetites now, and especially as it pertains to volatility. But you've got the three notable talking points right now being, the supply chain nightmare, energy prices, and inflation. If you're an options trader, what are you looking for with these storylines prevalent and seemingly not fading from storylines anytime soon?
Well, thanks for asking me such an easy question. I think that what we're seeing in the options market is an excess of near-termism. So if you were to go take a look at the CBOE futures curve, you're going to see that it's more steeply sloping, that it shows elevated risk in the future. That's a normal shape, but the question is it more elevated than it should be? And that's the giant debate. So you're seeing certain event risk priced into what's called kinks in the curve, reflecting inflation, stagflation, the debt ceiling not being lifted, rates rising, the 10-year is now 1.65. These are being dealt with oftentimes in the options markets by focusing on weekly options. So if there are 252 trading days in a year, what you're seeing now is most people have gone, I won't say most, many people have gone from expressing views 3 months out into the future, where there's this often perfect mix of volatility and liquidity, premium, and they're bringing it in much, much closer. So you're seeing a lot of stuff occurring in 1 to 2 weeks segments. And that's really what the cadence is in the options market. Now, if you can engage in what we call time arbitrage, there are ways to take advantage of some of the short-term and even long-term concerns within options, and that's sort of the beautiful sort of nature of the puts and calls. But people are staying in close. They're not taking on huge amounts of risk, and they're doing things that are reflexive, like the expectations are pretty tepid for third quarter earnings. So what do people do? What you've seen a lot of people do is they just buy calls on stocks that they think are going to do better than expected. And guess what? so far that strategy has worked. Now you take inflation and stagflation, which are these terrible hobgoblins, and you throw in the supply chain issues. And strangely enough, what you see happen is there's a paucity of risk-averse trading going on. You're not seeing people do huge index hedges in SPX, which is really the strategic hedge,
right.
Nor are you seeing a massive amount of tactical hedging or shorting in spider options or other such barometers. And to me, what that says is that the options market, which I think is a smarter version of the stock market, is taking kind of a trust but verify approach. So they're still afraid of being outside of the market and missing out, but at the same time, they're not willing to go 100% in. And how that gets stacked out is largely a personal question, determined by psychology, age,
everything we just talked about. Yeah.
But this is not. We're staying very close. It's like being in a close quarters combat, right? As opposed to going on these long range reconnaissance patrols.
You brought something up that I hadn't really hit me until then, but when we profile stocks that have an unusual options volume for either the day or for the week, it's almost always the weeklies that are attracting the most attention right now. And it's been like that for a while now. I had never really pieced that together, but you did that in a way that really kind of enlightened me here. So thank you. As we're gonna start to wrap up here, anything crazy happened in your career as far as a story wise in the investing world that would end up as a lesson for a potential options trader?
Well, I'll tell you, one of the greatest lessons that I learned and that I was taught was what I call the good investor rule. Mm-hmm. And it basically animates everything that I've ever done at Option Solutions. All the way through to the journalism and book writing. Mm-hmm. And the good investor rule to me is simple but profound. And it was taught to me by a CBOE trader. He said, bad investors think of ways to make money. Good investors think of ways to not lose money. And I remember when I first heard that, it was just about the time of the internet bubble preparing to burst. This is like 99 or something like that. And it struck me like a ton of bricks. And then I began to be very aware of this sort of chasm between what is generally said and reported about the markets and what really happens amongst this more sophisticated. They used to be an institutional group, but now they're not. Now it includes individual investors who are just so sophisticated and smart. And that's probably my greatest insight or realization from doing this. And as I said, I've used it in every aspect of my investing career, from being a columnist and basically being one of the first guys to ever cover trading. Mm-hmm. We never covered trading in the big newsrooms. We just stocks went up, here's 6 corporate actions or a rating change. Nobody ever really focused on the hedge funds or people buying this and this commodity or that index or stock. And we did that. And I also introduced what's called a risk graph. It's which has become kind of the common furniture in a column. So we'll say, we'll think about the trade, but in deference to the good investor rule, we're also going to put the risk factor in. As opposed to somebody told me earlier today, says, do you know why the securities laws at the state level are called blue sky? And I said, no, I don't. And he says, because they wanted to prevent these brokers from selling people blue sky. And that good investor rule has been a really, really good, meaningful sort of companion for me. And same with Humphrey, with the Contrarian, which I do credit Bernie for introducing me to. And I keep that book, the Contrarian Investor, close to me, and I look at it. And you think about the public is right on the trend, but wrong on both ends. And those are the things. Now, if you want funny stories, we could go on for hours. One of the things that was so great about open outcry trading were the people. And what I loved about all of the exchange trading floors is that they reminded me of everything that was great about America. Frankly, were anybody can come down there just with their wits and their brain and willing to work hard, and they can make something of themselves that was different and better than anything that happened to their families before. Mm-hmm. And these guys were basically financial pioneers, and I think they were some of the smartest people that I've ever been around, and they had incredible senses of humor. So, if you would see something trading, or you might call the different trading pits to see what was going on. And I remember one day somebody said, there's nothing going on, but they got two old guys, and we're all betting $500 to see who can run the fastest around the SPX pit. Something crazy like that. Now, that doesn't happen anymore on big bank trading floors. As much as the market has grown and evolved and become such an important part of the global financial markets, we've also sort of lost a little bit of something to history.
Yeah, something to get the juices flowing, or just, when there's just a little bit of more, dare I say, fun, or kind of a lightheartedness to it. I don't know, maybe not.
I think there probably was. I remember the first time I went to an options conference. I'm about 6 feet tall and reasonably fit. And I remember going there and thinking, like, holy God, I must be in the wrong convention. These guys are all like 6'10". I thought I was there at like a stevedores convention for dock workers or something.
Wow.
And I was one of the smallest guys there. And then you fast forward after electronic trading is introduced, and and it looks like a bunch of guys with degrees in physics are running the markets, and in fact they are.
Yeah, that's incredible.
Yeah, it's been a funny shift.
So to wrap up here, I always want to have my guests plug their own projects, their own website. So I'll give you the floor here. Do you have anything you want to promote, to talk about? I mean, the floor is yours.
I think the only thing that I would promote is that people just think a little bit more deeply about what they're doing in the markets, that they consider themselves perpetual students and stay away from ever thinking that they have any sort of mastery over what takes place on the tape, that this world of ours of puts and calls is endlessly fascinating and endlessly changing. And if you give yourself the time to study it, you'll become a better investor. And I think you're going to think a lot more clearly. So for me to be able to write the column still, that's always a great gift. I love that connection with this incredible readership. And at the same time, as I look around at the market, and my partners and I look at it, we sort of see a need for a firm like Options Solutions that helps people use puts and calls to curate their own portfolios. And the challenges inherent in that are endlessly fascinating. I always feel like I get paid to solve puzzles, and to me, that's what the options market is all about. And I bet you probably feel the same way with what you do. And people can sometimes get a little bit shy or turned off by the initial sort of complexities. Everything seems to be a little bit more difficult than it really is. But I really think that if anybody just spends just a few hours a month, that's all, trying to understand what happens in these markets of ours, they're going to have much different outcomes. And if they don't have much different outcomes, guess what? They're going to understand why they didn't have much different outcomes. And
you learn from that. And
that's right.
And then you move forward. Yeah, that really speaks to me, especially as far as you're solving a puzzle, you're figuring out an angle, a narrative. So, I mean, Steve Sears, it's been an honor. Thank you so much for coming on. Again, President and COO of OptionsSolutions.com. Check him out there. Once again, that's OptionsSolutions.com. Check him out on Twitter. Let me pull up his official handle here. SM_Sears, VIX's uncle. Steve, again, thanks so much. This was incredible.
Had a great time with you. Thank you.
Incredibly illuminating.
Thank you so much for having me.